To introduce our speaker, in a moment, I'll invite club member David Thane with classification of insurance to introduce John Adams. One of our favorite January programs is an economic update and some ideas of what business leaders can expect from the coming year. Now that reminds me of a true saying that's been true to me anyway about annual presentations. And that saying goes like this: I know you think you've heard this before, but I encourage you to pay attention. Sometimes the truth changes. During the program, we'll ask our Zoom participants to enter your questions for our speaker using the Zoom chat feature. Our club sergeant-at-arms, Ken Grant, classification of marketing, and our resident Australian ambassador on Australia Day. Ken will moderate the Q&A portion of the program. Before I return to the podium, we'll also have some upcoming event announcements from John Steckler, classification of business consultants and services. Now to introduce our featured speaker is David Thane.
Thank you, President Jimmy. For many years, our club has welcomed an accomplished financial or economic advisor to provide an economic update. Many of you may recall hearing from Jamie Dimon, currently the CEO of JP Morgan Chase, or Frank Russell from the Frank Russell Company. This year, we are most fortunate to hear from one of our own members, John Adams, who will share his views on where the economy is, and his timing couldn't be better with the announcements coming from the Federal Reserve. John is a senior portfolio manager at UBS and leads the Arbor Group's investment team. The Arbor Group portfolio management team works with UBS financial advisors in the Pacific Northwest and across the United States, where they manage portfolios with a focus on long-term sustainability using environmental, social, and governance screens, otherwise known as ESG. The Arbor Group manages portfolios for institutional clients and has a long history of working with foundations and endowments around the world. In fact, they are one of the largest managers of endowments and foundations for national parks outside of the United States. This is a special passion for John because he believes firmly in protecting the world's last great places. John is one of the founding members of Rotary Malaria Partners, now Malaria Partners International, and a loyal 18-year member of our club. Please welcome John Adams to the podium.
Hi, David. Thank you for the wonderful introduction. And I'm just going to make sure that the screen can be seen by everyone. So it's really wonderful to see so many Rotary friends today and welcome guests also. We've got a lot going on in the world, as David mentioned, and the thing that I'm going to do is take you on a short tour of what the major issues are of the day that might influence your life in the year ahead and also your investment portfolios. So the thing that I do is I oversee an investment team at UBS, as David mentioned, and I head up the stock research and portfolio management section for that team. And so we have to sift through the daily data just as you do in making decisions. So let me just point out what has happened today. Today we had another 800-point swing in the market. We've seen huge volatility lately, an 800-point swing yesterday, 1,200 points on Monday. This shows that there's a lot of uncertainty. Today's news, we saw Stephen Breyer resign or give notice at the Supreme Court, which is going to put that vacancy into an open position. Jay Powell and the Federal Reserve Board spoke today. They had a meeting of the FOMC, and rates have remained unchanged. And they also said they were going to stay on course in terms of reducing their infusions through the balance sheet in March. So they're basically staying on course with no new news. And then we saw Anthony Blinken, our Secretary of State, request that all U.S. State Department personnel leave Kiev and advised all U.S. citizens to leave the country. And that can only mean that they're very concerned about a potential war between Russia and Ukraine. So how does this all add up, and what are the important signals for you? Well, what's the backdrop? We saw a rather severe recession at the beginning of the pandemic in 2020. What has happened since then? You can see each of these bar charts in dark represents 2021 and 2022 in the forecast. And what you're seeing on a worldwide basis is very strong economic growth, not only last year, but also forecast for this year. So this is true across developed and emerging markets, the US, the Eurozone. And so let's go into what is causing that a little bit. Well, the first thing is the pandemic has really dictated what is happening in the economy since March of 2020. And you can see here charts of the second wave and then the third wave, which was known as Delta. Second wave was this time last year, which was an extremely large and deadly wave of COVID across the United States. Delta hit in July after striking India first, and then the Omicron wave hit at the end of the fall, as you know, and that appeared to come from South Africa. And what you'll notice is that in each of these events, you've seen severe disease and especially hospitalizations taper. Now, more people have become infected with Omicron, which is why you see the rather severe situation that you see now. But on a per capita basis, you have a lower level of hospitalization. Well, the important thing is that the cases have decoupled from deaths. And so you can see that the cases spiked here at the beginning of this year. And if this had happened at the beginning of the pandemic, we would have probably had to go into complete lockdown for an extended period of time to preserve our healthcare system. At this point, it's highly taxed, but you can see that the death rate from COVID has dropped rather significantly. And in some areas like the Northwest, it has rolled over and we're seeing steep declines. So what has happened as a result of that? Well, if we look back a little ways, what you'll see is that the lowering of interest rates, which was part of the Federal Reserve stimulus plan, has reduced interest payments as a percentage of disposable income for US citizens to a 40-year record low. Right now, just a little over 8%. And you'll also see that there was a very high personal savings rate that began right at the beginning of the pandemic. And that built up about $2.5 trillion in excess savings, or savings that we haven't seen before on US personal balance sheets. So that savings rate has come down. However, we still have very large pent-up reserves. The demand for goods has surged to record levels. And when you think about it, if you're going to spend money on services and goods, and you have to spend most of the time at home, other than watching the movies that Bill Center recommends on Netflix, you're probably going to find that your demands for goods have increased versus your demand for services. And that's the trend that we've seen. Now, crude oil demand is actually a pretty good way to look at global economic activity. And although it's not good from a climate change perspective, we're seeing demand recovery across most countries in the world. And we think that we're going to see record demand for oil and natural gas in 2022. So what we're noticing also is that we have supply chain problems. This is highly inflationary, and what you can see right here is the ISM Customer Inventories Index is showing inventory is far too low. And I'm sure many of you heard the announcement today that it's becoming a national security concern that the chip inventory, which normally stands at 40 days, is right now at 4 to 5 days. And this is causing huge production bottlenecks because almost every durable good requires some type of a chip, especially automobiles and all, fairly sophisticated transportation devices. So I'm going to keep moving briskly just so we have plenty of time for Q&A. But the thing that we're going to talk about next is what's happening in the labor markets. So we have a lot of job openings in the United States. At this point, it's sitting at about 3.2 million job openings. And coincidental with that, you can also see with these record high levels of job openings, we have very low unemployment. It's running at about 3.9%. Last year, it was at 6.8. So we've got a pinch on right now, and you've seen that play out for many of you that are employers. It's extremely hard to get new talent. And the thing that we believe at UBS is that primarily has to do with the pandemic. There are millions of people that are staying at home, especially women, because their kids are not back in preschool or kindergarten, et cetera. More children are getting back to school at this point, but it's a slow road. It's going to take a few months before there really is confidence. And there are several million people that are voluntarily standing out of the workplace just because of health safety concerns. So this has actually caused record increases in wages for people in the bottom 40% of the wage bracket. And so I think that there are some positives that have come out of this, but don't expect this to resolve soon. Even though we expect to see several million people go back to work, we're going to see continued low unemployment and significant wage pressure for the next year or so. So how is that affecting business? If we look at the largest 500 companies in the United States, that's the S&P 500. So there are 500 companies. It's technically 505 stocks because some companies like Berkshire Hathaway have a couple of different classes of stock. I think you'll see something surprising here. So both 2019 and 2020 had very low growth rates, only plus 1% in 19, and then a significant fall in the recession of 2020, 13% reduction, followed by earnings hitting new record levels in 2021, and an expectation of a 12% increase to corporate earnings this year. Surprisingly enough, despite all the headwinds, inflation, wage growth, et cetera, we're expecting a 9% increase to follow that in 2023. We know on a personal basis, we've all talked to business owners that are saying, well, my margins are pinched. A lot of it has to do with the fact that we really haven't seen demand come back in services because people are being so careful about their health. However, if you look back to 1995 and you trace what happens when inflation rises and what happens to business margins, it actually maintains. Businesses are usually able to adapt in a pretty flexible way and adapt to inflation. And so we expect to see that happen again. This is a little bit complex, but this is the part where we start talking about impacts on the market and therefore the investments that you may be in charge of serving on a board or looking at your own 401k account. So the largest sectors of the market are information technology and financials. And if we look at what happened in 2021, you can see that the performance of infotech was the single biggest driver of the overall performance of the market. And we saw a smaller performance out of financials. Now, the biggest gains, if you look down below, are in the energy area, where the average energy stock, these are oil gas company stocks, was up 48%. That's a pretty rare portfolio return, followed by 42% to real estate. But these weren't major contributions to the overall market. If you held an index fund, both of those categories are only about 4% of the S&P. So, some people make outsized bets in those areas, but those tend, especially the energy patch, to be extremely volatile and dependent upon demand and prices. This may be the most important thing because this has to do with the future and valuations right now. So let me just take a minute to explain this. If we look at what happens when the price earnings ratio, that is the price of stock compared to its earnings, when we're looking at a very low number this is on the left hand side of your screen, you might expect, say, an 8 times multiple to see returns averaging for the next 10 years around 18%. Whereas if you go to the far right-hand side of the screen, where we saw valuations, say, at the top of the dot-com bubble, what you might see for the next 10 years are negative returns. Well, based upon the multiples that we see today, and the S&P is trading about 21 times earnings today, we would expect to see an average return over the next 10 years of about 6%. So that's a 10-year forecast, and that's a pretty tame return. That's way below the average that we've seen for the last 30 years or so, which has been around 10%. So what gives, and what about the next year? Well, valuations are high right now in absolute terms, if you look at this average since 1985. However, what you'll see is that when you compare stocks, and stocks are always, not in isolation compared to what you can get if you invest your money in the bank or if you put your money into bonds. And compared to bonds, we actually see that stocks are reasonably inexpensive. And I can go into this in detail later, but if we look at this on a long-term basis, what we find is that most investors are overweighting in equities because bond yields are so low. So we think that there's another pretty strong indicator that returns might be good in the next 12 to 18 months. And that is the American Association of Individual Investors net bullish reading is lousy right now. In fact, it's at about 25%. And whenever we see people highly pessimistic, especially individual retail investors, that is usually the best time to invest. And what this shows on the right-hand side, by the way, is what happens if the manufacturing index is above 53 and the net bullish reading is below 25. And you can see that returns during those periods of time, over a 12-month period, have averaged a little over 18%. So we might have a return over the next year or so that could look better than what we expect as a 10-year average. So what's happening with interest rates? Well, interest rates will likely trend higher. The futures market is pricing 4 increases in interest rates from the Federal Reserve over the next year and 3 the following year. We'll see if we get that far, but what you can tell is if we look back to 1965, we just came off of 100-year lows in the summer of 2020 in interest rates, and interest rates have been moving back up. So the 10-year Treasury yield is still right now at about 1.8%. It's still historically very low, and we don't think it's a threat to things like people being able to take a mortgage. And so we don't see at this point interest rates getting in the way of economic growth. Well, what happens when the Fed does start raising interest rates, with the likelihood that we'll see many hikes ahead in the next 2 years? Well, you can see that average returns are actually positive after the Fed starts raising. Now, the Fed has overdone it a few times, and they're being very, very cautious right now, especially in terms of money supply, which is a different lever that they use. Interest rates is one, and the other is controlling overall money supply. And the Fed has been draconian in the past, and there are several instances where they've reeled back money supply too quickly and caused a recession. They know about that, and they're watching this carefully. So what do we like? What do we not like? Well, the thing that we think is that interest rates are more important for sectors and not the market. So if we look at the correlation between sector performance and the 10-year yield, if interest rates are rising, we see financials where margins usually improve as interest rates rise. They tend to do the best, followed by energy, where you saw these incredible returns last year that we talked about already, industrials and materials. Lagging usually real estate, which is negatively affected by real estate, by interest rate increases, consumer staples, utilities. So you can see that different sectors of the market are affected differently in this type of period. We know that growth valuations are traditionally high. And so we still think that growth stocks are vulnerable if interest rates rise, especially if they rise faster than is anticipated. And we also know that rapid economic growth, or GDP, just gross domestic product growth, benefits value over growth. So this is a period that we think is very similar to March of 2000 to March of 2003, when we saw fairly significant outperformance in the value category. Another area that we think bears attention right now is small and mid-cap stocks. So we're actually expecting to see much more significant earnings growth in the mid-cap sector than anywhere else in our economy. And so this is the top performing asset category in the United States over the last 40 and 50 years, with large variances in the short term. But if you look at the fact that the valuations are more attractive now and earnings growth is poised to be higher than in the large caps, this makes us especially attuned to that. And you can also take a bias and you can invest in small and mid caps in the value sector. And we think that that's where the bullseye is. So to conclude my short presentation here, we're recommending a risk on and pro-cyclical stance. The most preferred assets we think are US mid-cap, US large cap value, Japanese equities, which haven't done well for a long time and look very reasonably priced, and Eurozone equities, which are already outperforming the US this year. Least preferred, US government fixed income, investment grade corporate bonds. We think lower quality credit will actually outperform. And gold, we think it will actually abate in price over the coming year. So this is the first part of a presentation that our group will be giving via Zoom on February 1st. If you want to hear an hour-long version with somebody that really knows about the Fed and interest rates, and a specialist that will talk about things like clean tech, robotics, 3G, the metaverse, that type of thing, well, just email me and I can give you a link to that. At this point, though, I'd like to open up to any questions that you have, and maybe I can answer a few of them. So,
thank you, John. Really appreciate it. Good to see you. I'm going to start with the very first question. I want to know what in the world happened to Rivian, my favorite truck stock. They go and open up this huge IPO, and I heard this week that they're now a junk bond. What in the world? Explain that in 30 seconds, please.
Okay, well, just because a company goes public doesn't mean that it's earning any money. So it has revenues. They have 100,000 electric vans on order with Amazon. but they spent a lot of money setting up production facilities. They've only turned out just a few hundred, and you could call that prototype phase at this point. And they've raised money, but they're also losing money at this point. Now, Ford and Amazon have both made huge investments in Rivian, and they're stable stock owners. I would say that Rivian's one of the more speculative investments that you could consider making. Maybe the toughest challenge that they face is that Ford, which sells the most popular truck in America, has announced the Ford Lightning, and they've already brought in so many orders that they had to close orders, a little over 200,000 orders. And we've seen GM step right up and say that they're going to have production of an EV truck that will be available in 23 that will have even more range. So that and the Tesla wedge truck likely coming out in early 23 also. This means that there's a lot of competition for Rivian, so game on.
All right, great. So I'm hearing hold. Can you please describe your sustainable investments practice?
Well, the thing that we do is listen to our clients, first of all. And for institutions, that means that we actually go through the investment policy statement or work with them to listen to what the mission is and make sure that investments that an organization is making, for instance, the national parks that we manage, they want to make sure that they're not investing in companies that engage in widespread environmental destruction at the same time that they're trying to conserve some of the world's last great places. Likewise, for individual investors, I find that I know many people that have personally run into problems where they have a child that's been treated for substance abuse or alcoholism. They have a relative that died of an opium overdose, or they have seen violence with firearms. These are all things that can be excluded from a portfolio. And so the thing that we engage in is, and David mentioned ESG, we look at various metrics also in great detail that don't involve exclusion. So that's the first pass, is making sure that for clients, their values are adhered to. But if you do integration, what that means is that you're looking at how the earnings and the profitability of companies are affected by things like excessive executive compensation or litigation, hazardous spills in the environmental area, et cetera. You get the idea. Finally, there's something that's really pretty great going on, and it has to do with the Sustainable Development Goals. We see many people in the C-suite, the executive suite of companies, that are paying attention on an aspirational basis to the Sustainable Development Goals. And I'll just give one example of a local company, Microsoft. So Microsoft, a few years ago, pledged to be zero carbon. And more recently, what they did is they evaluated all their carbon emissions since the founding of the company. And they decided that they were going to offset those. And so what you have are people in the executive suite that are paying attention to Sustainable Development Goal number 13 in that case, and making aspirational moves to improve the world. Most of the S&P 500 companies, in fact, most of the 3,000 largest companies in the world, are paying attention to the Sustainable Development Goals. If you're going to keep your eye on anything as an investor, that's actually going to move hundreds of billions of dollars of capital as companies move to be more sustainable and fall in alignment with those UN goals.
Okay. You want to play some lightning round with me? 30-second answers?
Go for it.
Because I got a lot of questions and I've only got 3 minutes left. All right, let's go. How would you describe the economic health of Seattle versus other cities in the US? Go.
I'd say absolutely superb. And I think it has a lot to do with energetic millennial talent and an incredible technology and manufacturing sector.
All right, I like that. John, value or growth-oriented equities funds, where should investors be placing their financial bets? I think you already answered that in your last slide, yes?
Yeah, and I would further state that if you can handle the extra volatility, you'll find having some small and mid caps as well as those large caps is probably going to help out. And look for investing globally. Most Americans are under diversified and have most of their assets in the United States. And we may see a stretch here for the next few years where emerging markets and especially the UK and European developed markets are going to be pretty competitive with the US, may even outperform.
All right. Inflation is on all of our minds these days. What are your thoughts on how to adjust our investment strategies? It seems like you just touched on that too.
Well, the things that are long-term inflation proof that have proven out for 100 years are real estate and equities or stocks. So the really key thing, if you're in an environment where the short-term signal is a little over 7% inflation, the IMF said they expect it to be around 4.4% for the year 2022. Any way you look at it, the number's pretty big. And if you look at your savings account or the rate that you get on a bond, it's very likely you're going to be under that rate of inflation. So again, if you can hold long-term and stand the volatility, you're better off in stocks and real estate. That's how you keep ahead of inflation.
John, you are the man. We've all become so much wealthier after today's conversation, mentally and probably, if we're really listening to you, in our pockets. So thank you for all your time today. Really appreciate it. Thank you.
Yeah, thank you.
You probably know what's coming next, but on behalf of our good friends over at Harvest Against Hunger, they have donated in your name 600 healthy meals. So you've got that going for you today. That is some good karma. Wonderful. And then a quick shout out to all of our major sponsors this week. We're going to start with our good friend Liz Powell at Remax on Market. And of course, Bob Alexander, our 2 gold sponsors. But we also want to include Morgan Stanley and Joel Farrell, Dominic Musafia and Seattle Divorce Options, because there is always the option. Good friends at Jarvis and I can never do this one, can I? Jacobson and Jarvis. And special shout out to Matt Bretley and